Hi everybody, welcome back to the basics of GST tax for what's going to be part 20, the final part of this series. Today we're going to tie up some loose ends and look at transferor shifts, non-exempt trusts, and some of the basis rules that are unique to the GST tax. So before we get started, I want to remind you again, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So we've covered a lot of ground over the last 19 and now with this one 20 installments, but keep in mind this is designed to be a series that looks at the basics of GST tax, and there's a lot of depth you can develop in any one of the areas that we've discussed so far. So I'd encourage you to read further if you are interested in any of those areas, especially things like allocation of GST exemption and how that might apply if there's a late allocation. There's a number of other areas like that you might see pop up, like maintaining exempt status after, say, a decanting or modification or division of a trust. Those tend to be the hot button areas where we see this, late filings or maintaining a trust's GST exempt status. So you may need more research. You can't rely on this class to know enough for those, but we've covered the basic principles, and that should give you a knowledge to know exactly where to look. Now, what's coming down the pike? For one, I have a more comprehensive course I'm going to develop on the actual 706 and 709 filings for GST tax. Now, I will say so far that I give a lot of these classes on YouTube for free, including this series. So how can you help me out? Well, one, stay tuned for that comprehensive course. It is going to be a paid course, but I'm going to soup it up a lot more from what I've done in this presentation or series of presentations, so that'll help. And also, if you can't tell, I enjoy this. I love speaking and teaching. So one way you can help me out is if you are part of a group like an estate planning council, bar association, financial planning association, anything like that. Reach out to your group. Say, hey, we love Griffin as a speaker and teacher. We think he'd be great for any upcoming program. So recommend me and get my name out there. The more you can do that, the more you're going to help me out, because my goal is to take this subject matter and take it to groups across the country. I love that in-person speaking element, and I started this project 29 months ago in the midst of COVID with the goal of developing speaker opportunities when the things opened back up. Well, now they are. So please feel free to reach out to me at the email address below if I can fill your speaker needs. So with that being said, let's jump into the meat of today's presentation. So we're going to kind of be all over the place, but I've done my best to tie some of these concepts together. We're going to start with the definition of transferor, which ironically was the very first definition we looked at in this course and is going to be the final definition we really look at in this course as well. Because as I emphasized at the time, to have a GST transfer, you have to have a transferor under the technical terms of the GST tax rules. And to have a transferor, you have to compare the age or generation assignment of the person making the transfer and the person receiving the transfer. That's been the foundation upon which this entire course has been built. However, what happens if in the course of what appears to be a GST transfer, the transferor changes? Let's take, for example, a deceased parent who set up a dynasty trust for their two kids. It's divided into separate shares for the two kids at the parent's death, and child one dies while having some living children of their own, grandchildren with respect to the original parent transferor. However, the child has a general power of appointment over the trust at death. So what's the outcome here? This looks, at first glance, like it could be a taxable termination, but in this case, the child has those assets included in their gross estate by virtue of their general power of appointment. So what's the outcome? Well, this means the parent's prior use of exemption is wiped out. Now child allocates their own GST exemption to the trust because they're the new transferor. And their children are no longer skip persons, but the children's children in the future, if born or not, who become beneficiaries of that trust might be. So you have to be careful about looking at how a trust has transferors who could shift over time by virtue of gross estate inclusion or by virtue of the gift tax rules applying to certain releases or other things within the trust itself. Now, this is a bad outcome if this trust was already GST tax exempt. It causes some wasting of GST exemption across generations. But would this matter if the parents had not previously allocated GST exemption to the trust? If not, and the child had enough GST exemption to make the trust become GST exempt, this might be a great outcome. This might be, light bulb, some very good intentional planning we can do for a situation where we don't have a fully exempt GST trust by virtue of the original transferor's allocation of GST exemption. Which brings us to some final points on non-exempt trusts. So non-exempt trust I'm going to classify as a trust that has an inclusion ratio typically of 1, but more often between 0 and 1. And remember, our goal throughout this course is if we have this situation, we want to create a trust with an inclusion ratio of 0 and a trust with an inclusion ratio of 1, instead of having a trust that has some kind of middle ground inclusion ratio between 0 and 1. Because with the 0 inclusion ratio trust, it's very easy to administer that in a way that favors skip persons. And for the inclusion ratio of 1 trust, it's easy to administer that in ways that favor non-skip persons. So, with that trust that has an inclusion ratio of 1, what are some of our strategies at the top of the bell curve? Well, they can include things such as, and by no means is this list all-inclusive, but these are the biggest boxes to check. 1, by the terms of the trust or even by the trustee's discretionary authority. You could make distributions preferentially for non-skip persons from the trust with an inclusion ratio of 1 if those non-skip persons are also beneficiaries of a trust with an inclusion ratio of 0. The goal would be to drain the non-exempt trust during Generation 1's lifetime and preserve the exempt trust for Generation 2's benefit. We could also look to the exception which allows for gift and GST tax purposes the direct payment of medical and tuition expenses on behalf of any individual. In this case, if there are skip person beneficiaries under a non-exempt trust, we can use that exception to allow the trustee to pay directly on behalf of those skip person beneficiaries their medical and tuition expenses, so that we're still making distributions for their benefit directly to the source, but those don't count as GST transfers, and there's no tax on what would otherwise be a taxable distribution. We could consider also the powers of appointment that a non-skip person might have under that trust. First off, lowest hanging fruit, most of the time, a non-skip person is going to have a limited or special power of appointment, which typically has no effect from an estate tax perspective and wouldn't cause that non-skip person to become a transferor if they exercise it outside of a handful of states that recognize what's known as the Delaware tax trap, which is a little bit outside of the scope of this discussion, but essentially it creates gross estate inclusion when limited powers of appointment are exercised in certain ways that either extend the rule against perpetuities or maybe create presently exercisable general powers of appointment in favor of other beneficiaries of the trust. But that aside, the strategy in play here would be to take that limited power of appointment and exercise it maybe in favor of a sibling or some other non-skip person in the same generation as the holder of that power, so as to at least defer when GST transfers, especially a taxable termination, might kick in. So for example, in our last slide, if that child had had a limited power of appointment, that would have been a taxable termination, but they could have deferred it by exercising that power of appointment in favor of their sibling in the same generation. Or, like we saw in the example, we could find a way to grant a non-skip person a general power of appointment, at least over the non-exempt part of any trust, so that those assets are included in the child's gross estate, and thus the child becomes the transferor and can allocate their own GST tax exemption to that trust. So, This is kind of a setup you'll often see in a well-drafted trust, that these boxes will be checked in terms of what you can do with a non-exempt trust. So keep those in mind, and if you are drafting, be conscious about these little points, and can they find their way in for good GST tax planning. Now, the basis rules tend to get a little bit tricky. So the GST tax is designed to duplicate the gift and estate taxes. So when it comes to the basis, we have to be conscious of how the tax rules between GST tax and gift or estate tax interplay with each other. Now, the basis rules are largely going to be the same, but with one catch we'll see below. And really what we're going to look at is each of the correlating basis rules in turn. Most of the time what we're going to be dealing with is a gift tax regime, because if you have gross estate inclusion like we've seen so far, typically that's going to create a brand new GST transfer and a brand new adjustment to basis by virtue of gross estate inclusion. We're going to wipe out everything we've done so far. So really what we're looking at are situations where we don't have that. We don't have a new transferor. We're still looking at a GST tax event with respect to the original transferor. So the gift tax will typically apply when you have a taxable distribution, or the gift tax itself won't apply, but the gift tax basis rules will apply. If there's a taxable distribution, or maybe a direct skip during life, inter vivos. It can also be the case when you have a taxable termination that's not triggered by the death of a non-skip person. That has its own rules if the not taxable termination comes about as the result of someone's death, that we're going to look at next. But in this case, if there's gift or GST tax paid out of pocket, then typically you're only going to get a step up in basis for the portion of the tax actually paid out of pocket that is allocable to the appreciation in the taxable portion of the gifted or distributed property. Otherwise, in most cases where we have no gift or GST tax payable, there's going to be a carryover basis. So the recipient is going to step into the shoes of the transferor and take their same basis. There's some limitations around that. For example, if the fair market value for GST tax purposes is lower than the basis, then there are some special rules that deal with whether and how you can transfer that loss to a skip person. We won't get into those today because I'm going to assume you know those. But one thing you do need to remember is that if you have GST tax paid out of pocket, that is going to increase the taxable gift amount if there's a direct skip. So what this means is that if you have an increase in basis for GST tax paid out of pocket, we're going to apply that after the increase in basis for gift tax paid out of pocket when we look at these ordering rules. So here's a quick example. This may muddy the waters a bit, but I at least want you to see the numbers in the process. So we're going to assume the transferor makes a direct skip gift of $116,000, and they've used all of their GST exemption and applicable credit. So they're going to pay gift and GST tax on each dollar of this transfer. And the property has a basis of $56,000. Why does that matter? Well, we'll see in a minute. First, for GST tax purposes, our taxable amount is going to be $100,000. We subtract the $16,000 annual exclusion from the $116,000 direct skip to get a $100,000 taxable direct skip. And since we've used our GST exemption, we're going to have an inclusion ratio of 1. So our rate is going to be 40%, and our GST tax is going to be $40,000 on that direct skip. Second, we looked at the gift tax effect. So remember, our taxable gift is increased by the GST tax paid, which was $40,000. So our total taxable gift will be $140,000 after we back out the annual exclusion there as well. And as a result, our gift tax on that $140,000, to 40% of that, is going to be $56,000. So of that $40,000 in GST tax and $56,000 in gift tax paid out of pocket, how much of that can be used to increase the basis? Well, you can't use all of that dollar for dollar. You have to figure out what portion of that is attributable to the appreciation in the taxable portion of the transfer. So to do that, first, for gift tax purposes, remember our ordering rules, we have to do the adjustment for gift tax purposes first. So our ratio of appreciation to the taxable gift amount for the gift was 100,000 divided by 140,000. Why? Well, our appreciation for a $140,000 taxable gift, we have to add back in the annual exclusion, which takes us to 156,000. We have a basis of 56,000, so that gives us appreciation of 100,000. We divide that by the taxable gift amount, 140,000. That gives us a ratio of 5/7. So that means 5/7 of our gift tax paid is going to give us a basis increase. So in other words, we can't increase the basis by the amount of gift tax attributable to basis. We can only increase it by the amount attributable to appreciation. So after this adjustment, our new basis will be 96,000 because 5/7 of the gift tax is 40,000. So we add that 40,000 to the basis we had, the carryover of 56,000 to have a new basis of 96,000. Next, we have to find the basis for GST tax purposes. So we again take the ratio of appreciation to the taxable direct skip amount, but we do it after the basis adjustment above. So we had a taxable gift of 116, or not a taxable gift, but really a gift of 116,000 with a new basis of 96,000. So the appreciation for GST tax purposes that we look at here is 20,000. We divide that by the taxable amount, 100,000, which will give us a 1/5 ratio of how much appreciation is attributable to the gift tax or GST tax paid out of pocket of 40,000. So what that's going to give us is 1/5 of 40,000, or 8,000, as our basis increase for the GST tax that was paid out of pocket. As a result, our new basis here will be 104,000. So lots of math, but it's something helpful to keep in mind. Now, I apologize for how long that example was, but thank you for sticking with me. We're now going to look at estate tax rules and how those could possibly tie into taxable terminations. So most of the time when the estate tax applies, if you have a transfer that already had a transferor, you're going to have to look at, does the transferor shift, as we saw earlier. But most of the time, property included in the gross estate gets an adjustment to basis, to whatever its date of death fair market value is, or the alternate valuation date fair market value, whatever is used as your measure for estate tax purposes. Now, the big difference in this step-up rule versus the gift step-up rule is that for the estate tax adjustment to basis, no matter what, you get the full step-up, and it doesn't matter whether or not estate tax is actually paid out of pocket. Now, what happens in the event of a taxable termination? How do we look at it from that perspective? Well, remember I mentioned there's a special carve-out for a taxable termination that's triggered by somebody's death? Well, that is going to really kind of invoke some of these same estate tax principles, but with a twist that it's going to be contingent, maybe not necessarily on the payment of estate tax, but more on the inclusion ratio of the property that's subject to the taxable termination. Why? Because a taxable termination is really kind of looking at the GST tax as replacing a layer of estate tax that would have applied had that member of the non-skip generation died owning the property instead of having it be held in trust. So because of that, when we have a taxable termination caused by the death of an individual, then there's going to be a step up or step down in basis like we would have under a gross estate. However, there's a catch here. We take the adjustment to basis and we have to multiply it by the inclusion ratio in this case. So the result is, if you have a zero inclusion ratio, there's no adjustment to basis in the case of a taxable termination. So really what this ends up giving us is ultimately a taxable termination adjustment to basis that becomes proportionate to the GST tax that was paid by the trustee. Now, for any other situations where we have a taxable termination that's not triggered by an individual's death, then we use our default rules where we have a carryover basis unless the GST tax is paid by the trustee, in which case we would adjust our basis by the portion of GST tax attributable to the ratio of appreciation to the taxable amount. But the big difference between that rule and this one here is that it's a much simpler calculation in the case of a taxable termination. Each asset that gets an adjustment to basis, you take that potential adjustment, whether it's up or down, and multiply it times the inclusion ratio that was in place at the time of the taxable termination. So, what are our grand takeaways for this entire series? So, for GST trust, you have to beware the effect of having a new person become subject to the gift or estate tax, because when that happens, that new person can become the transferor. That can wipe out any prior GST exemption allocations and also require that new person to allocate their own GST exemption by virtue of becoming the new transferor. So, when it's accidental, that's bad. When it's intentional, that can be good. And there are ways with this we can navigate the GST tax if we have a trust that ends up being non-exempt. So before that transferor shift happens, we can minimize the impact of that from not just a GST tax perspective, but also a gift or estate tax perspective as well, through distribution strategy and strategic use of powers of appointment as well. Now, finally, when the GST tax might be paid, in those rare occasions, you have to keep in mind the interaction between the basis rules for gift or estate tax purposes and the basis rules for GST tax, and look at how those interact with each other. But with that, congrats! You have made it through the basics of GST tax, so I hope you've come away with a little bit more knowledge than you had before and a better lay of the land from a 30,000-foot view. But from here, I'd encourage you to dive in, check out the code and regs to solidify your knowledge. I know it's not light reading, but it's easier reading when you have this broader perspective that I've brought to you. Like I said, there's more coming, possibly paid courses in this vein in terms of the actual gift and estate tax return strategy. So if you want to look at those, stay tuned through this YouTube channel, my newsletter, which is griffinbridgers.substack.com, linked in the show notes below, and my LinkedIn page. Just search Griffin Bridgers and you can find me there. I've got a website coming, but it's in the works. I don't want to commit to directing you there until I know where it's going to be and how it looks. So I want to leave you again with my ultimate call to action. Why do I do this? I want to speak to groups. I want opportunities to speak in front of people about these subjects I've talked about here: GST tax, planning, anything that's covered in my newsletter. So if you're part of or even on the board of an estate planning council, bar association, a financial planning association, any type of group like that, or if you have an upcoming conference or trade group type of conference with speaker needs, or even if you'd like me to give a presentation in-house, please keep me in mind. You can reach me at the email below. So here's our final glossary of terms. Check those off, and if you know each of those, you know the basics. So with that, if you have any questions or topic suggestions for future broader courses like this, you can email me at griffin.bridgers@gmail.com or fill out the survey in the show notes below. But please note, I cannot give tax or legal advice in response to your questions. But I thank you for joining me, not just for this video, but for this entire series on the basics of GST tax. I hope you've gotten a lot out of it, and I look forward to seeing you in my future content.